What is up, you guys? Peter Carlo here, and today I want to talk about margin. Margin is a question that I get asked a lot about from traders and investors alike. Not just people who are trading, but a lot of investors ask me about margin for a couple of reasons. So in this video, I'm going to explain what margin is, the pitfalls of margin, how you can actually use margin to your advantage, and if you are somebody who should really be using margin. But before we get into that, hit the like button, subscribe to this channel. It's the easiest way to support a small YouTube channel like myself so that we can continue to grow this community and I can continue to put videos out each and every single week. So let's get started. Now, the first thing as far as margin is considered is a lot of people don't even know what it is. Margin, the best way that I can explain it to you, is essentially a loan. A lot of people think to themselves, how is this loan paid off? How much money should I loan? When they hear the word loan, they usually freak out because they're like, I don't want to take out a loan. I don't want to owe anybody any money. But the truth of the matter is, I believe that every single person should have a margin account. Doesn't mean you have to use your margin, but I believe every single person, especially if you're a trader, should have a margin account unless you're trying to get around the pattern day trading rule, which I talk a lot about that in my videos. So you can just type in Peter DeCarlo day trading rule. You'll find that that's a way that you can get around it by having a cash account. Or if you're just a long-term investor and you don't want to have any margin, you don't want to have to worry about that, because essentially, when you have a cash account, which most people don't have, normally if you just sign up for a broker account, you're going to have a margin account. But if you have a cash account, anytime that you sell a position, whether it's a long-term investment in a stock like Boeing or Amazon, or you're trading a stock, what's going to happen is that interaction, that transaction is going to require 3 business days to clear the funds. So let's say that you have an account, a trading account for $10,000, and you buy $10,000 worth of Apple today. You sell it for a profit tomorrow. They're going to tie up that $10,000 for 3 days, basically just till the transaction clears, so they know that you have the money. And then once that transaction clears, then you're able to use the money to go out and trade again. So let's say that today you want to buy Apple, tomorrow you sell Apple, and then you want to buy back into a different stock or maybe start a position in a different company. You will be unable to do that until the money is cleared. With a margin account, what happens is, say that I own Apple, I sell Apple today for a profit, and then I want to go buy something today or tomorrow. What will happen is, instead of that transaction having to clear in order for me to get my money back, what they will do is spot the transaction up that's taking place and essentially just give me buying power. The buying power is just my money. So essentially, you don't have to wait for the money to clear. Now, if you're doing this, you're not being charged interest. The only time you're being charged interest is when you actually take margin or take a loan out of the account against your portfolio. So overall, I believe margin is important. Really, like if I was a long-term trader or a long-term investor, or a trader, I would have margin. I've always had margin, but it does with great risk, always comes great responsibility. Thank you, Uncle Ben. But, I do believe that it's something that every trader and investor should have. But where it gets gray is that these brokers kind of make it hard for you to realize, how much money is yours and how much money is margin. So let's talk about margin rates, because it's extremely important. And then we're going to talk about how to use margin properly. So margin rates is separate for every single broker. I think Robinhood is the lowest. Robinhood margin rates. I think Robinhood is one of the lower ones because they don't really give you that much. So 5% to 2.5% is their margin rates, which is very low. Now, a company like Robinhood, they'll give you about a 1-to-1 depending on the amount of money you have. So if you have like $5,000 in Robinhood, they'll offer you $5,000 in margin with a 5% interest rate. However, there are brokers out there like TD and E-Trade, will they'll offer you 2, 3, 4, 5 times what you have in your portfolio depending on the broker. So say you have $25,000 in your portfolio, they might offer you up to an additional $50,000 towards shares of stocks. Each type of security is going to have a marginable rate. So say you want to go out and you want to margin $100,000 on something like GameStop, you're not going to be able to do that because they're the bank. They understand that's a very risky investment. So they're not going to margin you that much money. They might margin you a little bit, but they're not going to margin you that entire amount. However, if you want to go out and buy Apple, they might be like, yo, here's $100,000 to go buy Apple. It depends on your account. It depends on your risk level, because they'll decide how much of a risk you are to the margin that they're giving you. And it depends on the security or the stock. Same thing with options. Usually they're not going to give you a huge margin when it comes to options. Now the rates normally for something like TD or for, E-Trade, it's about 10%, which is huge. 10% a year. If you're margining out $100,000, you're going to owe them 10 grand on that margin. So the biggest thing is when you're using margin to understand the rates and to understand if it's even worth it for you to margin out money. Because if you can only get a 10% return per year on your investment and you're going to pay TD Ameritrade or pay a broker 10% to use that, and on top of that, have a ton of risk because you're leveraging out your portfolio, it's not worth it. So overall, I think that margining money for trading purposes, like buying options and shares, is not the best idea. But one way that I love to use margin is by selling puts. If you don't know what selling puts are, go and just type in Peter DiCarlo selling puts. I talk about it a lot on this channel. Selling puts is great because what they do is it's very, very, very safe, and they'll take your margin as collateral. And this way, instead of just having, say you only have $10,000, $20,000 to sell puts with, what you could do is actually have $50,000 now to go and sell puts with. And it's a very risk-free way of making money. You're not gonna make a ton of money, but it's a very risk-free way to make money. Now, there are brokers such as Robinhood where they will not allow you to margin out puts. So if you want to sell puts and margin out some capital to sell puts, they will not allow you to do that. TD Ameritrade will. Now, as far as long-term investors are considered, I get a lot of people asking me about margin and long-term investing, because if you look at the stock market most recently, the past couple of weeks, obviously things have been pretty rocky. At one point, the NASDAQ was down almost 11%. So let's just say that you're somebody who's holding Tesla as a long-term investment. What I normally tell people to do is stay 20% to 30% cash, depending on how they feel the market is. So when the market's a lot more volatile like it is right now, for a long-term investor, I would say keep 30% cash. So if you have 100 grand, I'd have 70 grand in the market, and I'd have 30 grand on the sidelines to buy up things like what happened last week. You could have bought Tesla down at 575. You could have bought Apple down at I think Apple is trading at 110. Right? Yeah, you could have bought Apple at 115. There's a lot of different deals that happened last week that you could have taken advantage of. Now, what a lot of people like to do with margin is, let's say you have a $100,000 portfolio or even a $10,000 portfolio. What they'll do is, instead of keeping 30% of their capital on the sidelines, they'll have all their money in the market. But then when the stocks dip, what they'll do is they'll buy a bunch under margin. And their margin is kind of their cash on the sidelines. And there's a couple of reasons why you don't want to do this. The most apparent is that you're going to lose money twice as fast. So let's say you have $100,000 and you're in Tesla and your average is somewhere like 825 and the stock dumps 10%. So you go out, you buy another $100,000 worth of Tesla on margin. Now you have $200,000 in Tesla, but your portfolio is only worth $100,000. So what now would be an extra 10% move to the downside is really going to be a 20% move to the downside. So that means if Tesla moved down 10%, you would lose 20% of your portfolio because you're levered double, right? You have double the amount of shares that you would, so your portfolio is going to lose 20% instead of losing 10%. So it becomes a lot more risky. However, on the opposite side, if Tesla goes up 10%, you'd go up 20%. So it is powerful, but the second reason that I really wouldn't do this is because of margin calls. And we saw this happen last year when the stock market crashed because of the Rona. And what happens with a margin call, and the thing is, people think that when you're trading margin, you could lose more money than you have in your portfolio. And that's not possible. But what a margin call is, it happens a lot, especially when the stock market's crashing. Essentially, your broker says, okay, all right, Pete, you have $100,000 in Tesla and you're margining $100,000 in Tesla. You're down 20% on your position. The stock market's not looking safe. We need to get some money back. So they'll do a call. What happens on a call is two things. One, you either have to put more money into your account. So sometimes it might just be a couple $1,000s. Sometimes it might be $50,000. Depends on how much you're down. So you have to put a certain amount of money into your broker in order for them to continue to give you the margin. The second thing is, which happens a lot, is they'll just sell your position. They don't care. Remember that the broker doesn't care about you. You're just a vessel for them to make money. So let's say that you have, like I said, $200,000 worth of Tesla, you're down 20% on the position. They might not even tell you, and they'll just sell your position. You might wake up one morning, sell your position at the worst price down here at $580. They'll sell your position, and then they'll say, okay, they'll recoup their money, they'll take their money back, and then whatever's left over is your money. And then the stock completely reverses and you don't get to reap the benefits on the way up because they sold your position and took your money. And you have to remember, for a bank or for a broker, the most important thing for them is not to lose money. It's the most important thing. So getting a margin call like that can help. And I mean, can happen, and it will not help you at all, because if you look at last year, who expected the stock market to fall the way that it did last year, right? Like, I wasn't expecting the S&P 500 to fall off 36% and then completely recover 4 or 5 months later. So you would have never been able to get that recovery because you would have ended up getting margin called somewhere down here. And the more volatile the market, the quicker they're going to go to margin call you. And the final thing I want to talk about going into, your margin rates is the fact that a lot of brokers make it very hard for you to know how much money you're margining because they're sneaky. Like I said before, the way your broker makes money is by margining, because back in the day, they made money through commissions. Then Robinhood came in, changed the game, no more commissions. Even though I hate them, that's one good thing they did for traders. They helped us with not having commissions anymore. So now it's not like TD is going to lose out. They're going to find another way to take your money, and that's through margin. So say you have $10,000 in your account and you're just not really paying attention to what you're buying. You're like, okay, I want some Apple. I'll take some Amazon. I'll take some Uber. Oh, look, Microsoft looks really good. And then I'll say you have like $8,000 worth of buying power. Oh, cool. I'll go buy Microsoft. Oh, I still have $2,000, $8,000 worth. Still have so much more buying power left. Okay, I'll go buy this stock and this stock and this stock. You might not even realize it, but you might be margining $10,000, $15,000 without even knowing it. And the whole time they're charging you interest on that money. So it's kind of in their favor to let you have no clue how much money you're margining out. And they make it hard for you to understand how much of their money you actually have out. So once again, to kind of wrap this up, margin, I think everyone should have a margin account. You don't have to if you don't trust yourself, or if you just feel like it's not necessary, you don't need to. But I do believe everyone should have a margin account. That doesn't mean everybody should use margin. I do think having a margin account is important so you don't have to wait for funds to settle. If you're going to use margin, use it in a responsible way. Sell puts with it, or potentially, if you're going to use the margin, have a tight stop loss, something to where you're not going to get margin called. And also remember the fees, and remember, your interest rate on it, and keep a log of how much money you have out there in the market at all times, so you know if you're using margin or not. You might be getting charged every single day and have no clue. Because think about it, if they take $10, $20 out of your account, you're not going to notice. Like, who really will notice that unless you're tracking everything? So thank you guys for all your support. Hit the like button, subscribe to this channel. Thank you for everything. If you want to be a part of our private academy, get access to every single trade I take live, every single investment that I take as I take it, get access to our Discord, which is our private community membership chat platform. And you can live stream with me every single morning for the first hour of market open and get access to our 60-hour course library. Thank you for everything. Hit the like button, subscribe to this channel, and I'll see you next time.